Hello and welcome to this month's market update. I'm joined by Casey Lowe, member of our capital markets and asset allocation team. Welcome, Casey.
Thank you, Carla.
Great, so let's get started and let's focus on China. What's coming up there this month?
March tends to be a really busy month for the Chinese government because they have what they call the two sessions going on during this month, which covers the top lawmaking body and also the top political advisory body coming together to set the agenda for the coming year and also beyond.
Great, so 2019, what's the specific plans there?
I'll highlight a few of the key economic targets. To start off with, they've set their economic growth target to be between 6 and 6.5%. So this is a slight reduction from 6.5% we saw last year. And then in terms of new jobs added, they're expecting to add 11 million new jobs this year. Now again, this compares to 13.6 million jobs being actually added last year. So again, slight reduction there. So overall, you can sort of see there that the government is expecting some slowdown in growth, and because of that, they've announced some supportive policies. Now, the key ones there are that they've announced some tax cuts for businesses. They've also announced investments into infrastructure. So these cover projects in the water industry, in the road and railway industries as well. So overall, I think the government's expectation there is that growth will slow down in 2019, but they have announced some supportive policy, but they are also watching this whole financial risk element of things. So they've announced that they won't let credit growth grow by more than the 2018 levels, and that they'll be having a keen eye on the pace of deleveraging as well.
Great, well there's a lot to keep our eye on there in China. And what about domestically? What's the key issues there?
So we've covered this before. So the Reserve Bank of Australia continues to talk about this growing tension between strong labour market data and softer economic data. So what they mean by this is GDP growth numbers have slowed down since mid last year to about 2.3% now. But then compare on the other side, you look at the labour market, unemployment rate is at 5.1%, which is strong numbers there. And then in terms of jobs being added, over the last 12 months, the economy has added close to 300,000 new jobs, so strong numbers there. So it goes back to this strong labour market data, but the economic data is not as strong.
Right, okay. And usually front of mind is the property market at this time of year, and I imagine there's a few lenses to look at that through. Could you talk us through that, please?
Yeah, so we try to look at it through three lenses. The first one, price, employment, and also the wealth impact. So on the prices side, we've seen house prices fall close to 10% on a national level, but given how much prices have increased in the last couple of years, prices in Melbourne and Sydney are only back to their 2016 levels. So not so good if you've bought a house in the last 3 years, but if you're a long-term buyer, not so bad either. Now from an affordability perspective, if you look at the house prices to income ratio, despite the fall in house price, that ratio remains quite high still, because there's been not much income growth. So that is a concern there. But interestingly, if you look at the Melbourne and Westpac surveys on when's a good time to buy houses, that's actually been improving in the last 6 months. So sentiment is not so bad.
All right, that's interesting. So if you are one of those house owners with a 20% fall sort of front of mind, does that really impact your consumption?
Yes, so the Reserve Bank of Australia have done quite a bit of research on this, and they've looked at it in terms of the impact on key household items. So what they've seen is that for a 1% drop in house price, the biggest impact is on your habit of buying a new car. So for a 1% drop, they would expect a 0.6% drop in your spending on buying a new car. But at the overall level, the RBA don't think the consumption impact is as large. So based on their analysis, they think for a 1% drop in house price is only around a 0.1% decline in household consumption there. Yes, and then maybe going back to the employment side of things on the impact on house prices. So what we watch there is on dwelling approvals. So
Mhm.
that tends to lead dwelling construction and employment by 6 to 12 months. And what we're seeing is that dwelling approvals have fallen quite sharply in the recent releases. So that would likely mean that in terms of dwelling construction activity and employment, that should slow down in the next 6 to 12 months. But we are expecting this increase in infrastructure spending to offset that partly.
Right, well, we'll see how that all balances out. Thank you so much for that update, KC, and thanks for joining us.